Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. After spending $16 trillion, or more than the GDP of China, on economic support measures around the world, adding $7.6 trillion of government bonds to central bank balance sheets, and running the largest budget deficit since World War II, the economic recovery is finally back on track. World GDP looks as though it will top 6.1% this year, an extraordinarily strong number, the highest since the early 70s, and that will take the world economy back to its pre-pandemic level somewhere around Q4 of this year or Q1 of next. But there are buts. First of all, the Delta variant is a growing source of uncertainty around the world, particularly here in the UK. Second, economic sentiment indicators, particularly business surveys and consumer confidence, are beginning to roll over, at least modestly. Thirdly, of course, this has been a brutally unequal recovery. The emerging world ex-China has suffered far more than the West, particularly Latin America and sub-Saharan Africa. So what does this mean for investment? Does it mean that we've actually passed peak growth? How should we factor into this into our strategy, and what does it mean for your portfolio? So let's get some perspective on this extraordinary recovery in the first slide. I've shown GDP growth in red and the contribution to that growth country by country in the coloured bars below. First of all, you can see that red line dipping only very modestly negative in 2008-9 into what of course felt like a very tough recession. Compare that to 2020 and you can see just the difference in scale. A fall of more than 3% this time round for every country in the world with the exception of China. What's important though is the scale of the recovery this time. Look at those numbers for 2021, 2020, 22 and 23 as this vast economic stimulus and central bank bond buying continues to support the global economy. As we looked at last week, you'd have thought that bonds would be cheering this by pushing yields higher. In fact, they've done exactly the reverse. Bond yields have fallen. As we saw, the US 10-year yields has rolled over to 127, that green line. Most extraordinary of all, the real bond yield, that's bond yields after inflation for the US 10-year, has fallen to nearly minus 4%. That's the lowest in 40 years. Totally counterintuitive. On the right-hand side, you can see an equally odd phenomenon here in the Eurozone. If I want to lend for 5 years to Italy, Greece or Germany, they don't pay me interest, I have to pay them. Now, possibly you understand 5-year negative interest rates for Germany as a protection against a European or Eurozone breakdown. But on the other hand, negative yields to Greece and Italy feel absolutely extraordinary. So are bond markets trying to tell us that world economic growth has peaked? Well, there's 3 reasons why that might be right. First of all, we're certainly not out of the woods on the virus, the Delta variant case continuing to rebound sharply. On the left-hand side on the left-hand panel, I've shown infection rates in the US per 1 million people in the last 7 days. Look at that surge in the UK, followed by France and the US. Death rates on the right remain thankfully low, but you can see the pressure on lockdowns and reopening that this will put throughout the world. Secondly, business surveys, although extremely robust, appear just to be beginning to roll over. The well-respected ISM survey for both non-manufacturing and manufacturing goods rolling to a still strong 60, but weaker than it was. Consumer confidence fading a little bit in the US, and I haven't plotted it here, but initial jobless claims up, showing an unexpected weakness. It may be just a month-on-month blip in an otherwise very robust labour market. The third worry, of course, is that the cost of this crisis has been hugely unequally distributed. The IMF has shown the difference in their projections pre-crisis and post-crisis out to 2024. As a result of the crisis, they expect the world economy to be 2.8% smaller than it would have been without COVID. But look at the distribution of that. The US is actually larger because of the COVID crisis. How can this be? Of course, it's the fiscal stimulus and infrastructure program from Joe Biden and his predecessor Trump. On the other side, emerging market Asia ex-China, Latin America, sub-Saharan Africa, showing huge drawdowns, 6 to almost 8%, as low vaccination rates and high food prices and trauma in the world economy reflects so brutally on those weak underlying economies in the emerging world. So how will central banks react? Well, we've had some more information this week. Remember that a few weeks ago, Chairman Powell of the Federal Reserve showed us his new inflation targeting framework. He's going to allow an average 2% inflation rate and run the economy hot if we've been below 2% for a while. Madame Lagarde at the ECB has done something similar. Not quite as generous as Mr. Powell. She's not going to compensate for past undershoots, but her new target of 2% is symmetric. In other words, the Governing Council considers negative and positive deviations from this target as equally undesirable. And in her press release yesterday, she seemed to plot quite a generous and slow exit from these pandemic stimulus measures. Put that all together, and despite a fading of growth, asset markets are still robust. Yes, we saw a dip last week over worries on that growth, but we seem to have recovered, supported of course by generous monetary policy. Global equities up 12%, gilts now down only by 3%, and gold down 5%. Look on the right for this aggressive rally in growth stocks, of course, loving this slightly lower growth outlook for the world. Of course, tech is relatively defensive in that respect, and on the other side being supported by government policy. So where does that leave our positioning going forwards? Well, for our regular accounts against a composite benchmark, we're remaining overweight, looking to benefit from very, very strong earnings growth this quarter, and of course supportive monetary policy. For our target return accounts, these follow an inflation plus benchmark where we're a little bit more cautious. We're easing back. We're dropping that equity overweight into this strength back to neutral and lifting cash to a little bit overweight. This is an early and a tentative move. It's a precautionary move. It's, if you like, getting out the umbrella while, as we see today, the sun is still shining hot. But I think it's the cautious strategy that might be well rewarded, as central bank policy error looks quite high against such an uncertain outlook. Well, thank you very much, and just to apologise, I'm hopefully away on holiday for the next week or so, so we'll miss the next series, but I'll be back to you at the beginning of September. Thank you very much.